Well, if they can actually do a little preparation, kind of planning ahead of time and be like, hey, I'm thinking about maybe going to talk to a guy like Dave and his company, and I eventually want to sell and it maybe sometime soon, then what we'd want to do is go, well, how much do you think you might be able to get? Like, and how much do you have in other investments? And what we want to do is,
Hey, welcome back to the show. Today we have Ed Meek on the podcast. He's at Edge Financial Advisors. And I was telling Ed in the pre-interview that I usually don't have financial advisors here on the show, but there was some podcast agents that reached out and there was an awesome one-pager. I clicked over into Ed and his colleagues have a YouTube channel. I liked what I heard and I was like, hey, let's get this guy Ed Meek on the show. So Ed, what's going on?
well, thanks. It's funny you say that. They've done studies recently, and I think like one of the last people want to talk to is financial advisors from a trust perspective. When people hire people like us, we're in the trust business. When they work with someone like us, they eventually have to kind of like put forth their trust because, as you know, in the world, things get super complicated, and this is not an area that people are somewhat experts in. There's a handful of people, but I appreciate you having me on and taking the chance. But I know exactly where you're coming from, and we love helping people. And I think you grabbed a great podcast that we had done, before. What was the name of it? The one that you really liked?
Yes. So you guys did a video called Lies You've Been Told About Money. And depending on time right now, I would love to ask you a few of the lies that we've been told about money. And then maybe we could talk about taxes and capital events, right? So like an exit or something like that, that it'll be something that the audience is interested in. A lot of practice owners, physical therapists, healthcare business owners that watch or listen to the show on iTunes or Spotify. And I just don't think there's a lot of great content out there. So that was one of the reasons why I started this. And if we can kind of talk about that, so maybe some money things, maybe some taxes. Again, you guys are going to have to speak to your lawyers, your accountants, all that, or your own financial advisor, or reach out to Ed directly. But let's get into that, because the first thing that caught my attention, that video, Lies You've Been Told About Money, there were some things that I was like, oh, wow, that was like either debunked a myth or an assumption or something that I might have either heard of or thought of. So like, I'll kick it over to you. What are some of the most common lies that we've been told about money?
Well, one easy one is Social Security is going to run out. And the reason is, it's kind of been out there for a while. And the reason is because it's understandably why people will potentially think that, just because the government isn't so efficient, right? We know that. But if Social Security did run out, or it was abbreviated, or something dramatic happened to it, a majority of America actually who's retired lives on Social Security. Almost all their income's on Social Security. If for some reason that happened, it would not just affect those people. It would collapse probably the stock markets across the world. So it's not going to happen. There's a couple of ways to solve it. In fact, I think it was Warren Buffett who said, if there's a problem, we could take care of the Medicare problem. We could take care of Social Security in about 5 minutes. And people were like, well, how would that happen? They said, well, we would just tie it directly to the performance of, senators. If they were incentivized to fix it, it would be taken care of right away. So there are solutions. People can live long, and people can just start it a little bit longer, but the voting base doesn't like that, but it's not going to run out of money. So that's an easy one.
I don't remember that from the video that you guys made, because I'm a little bit younger than you. I was kind of under the assumption that it is going to run out, and also to not gloat too much. But like, I feel like I'm 37. I feel like I'm not going to have to rely on it. Now I know there's all people that absolutely will need to rely on it or do rely on it. But that's one thing right off the bat. Like, I thought that it's because of the baby boomers. There's a significant number that are utilizing it, but there's not enough folks that are, I guess, that are 20, 30 or whatever age that are paying into it. There's not enough paying into it compared to how much is being utilized on the back end right now. So I'm glad that you clarified that, because I was under the assumption that it's absolutely going to run out and that we should not bank on it, and we should, create our own wealth or our own luck or whatever.
Yeah, I mean, I'm 55. So, my full retirement age, where I get like the full amount, because you can get anywhere between 62 and 70, is 67. They just one way to solve it would be yours might be 69 or 70. Like literally all of the numbers, if you just collect it a year or two longer, fixes the gap. But there's a variety of ways they can do it. Like I said, if they do something that dramatic, then we got a world of hurt in a lot of different ways. It's like a rippling effect that we just can't see that happening.
Now, you said it also would affect negatively the stock market. How, like, and not to pin it you against the wall with it, but like, how would that affect the stock market? Because the folks that rely on like their fixed income, right? They're not buying extra stocks all the time. You mean in terms of like how they don't have money to then go out into the, into the market and buy things, and that affects the overall commerce of the country? Is that what you mean?
Exactly. That's right. Imagine, and this is what happens when the markets struggle. It's not always directly tied to this, but when the markets struggle, it's because anybody who has any extra spending money, they don't want to, they don't go out to dinner anymore. They don't spend money in extra things. And all of a sudden, those companies that are directly tied or indirectly tied, they go down in value. The reason stocks go up is because it's the perceived that we believe that company's worth more and more and more because we think people are going to buy more. If people bought the exact same amount of iPhones, Apple stock wouldn't go up anymore. Apple has to keep being innovative. And the only way they can be innovative is people keep buying into the types of things that they want, and they're going to buy more and purchase more of Apple or whatever the case may be. And so all that extra discretionary money that people will get, hence through Social Security, is not going to be there. And so then the market collapses. And then, there's a chain reaction when it comes to companies. They're all connected. People aren't going to buy technology as much. NVIDIA won't sell as many. I'm just saying NVIDIA because that's the stock that's on fire right now. NVIDIA won't be able to sell as many chips. People won't use AI as much. I could just make stuff up, but it's not making it up. It's just examples.
Got it. Yeah. All right. So how about another big lie that we've been told about money that either you have to kind of debunk for your clients, or something that you guys on the financial advisory side, maybe you hear a lot when you do some new client intake and you kind of have to, like, you're building rapport. Like you said, it's a lot of trust. So you're building relationships with folks, business owners like me, business owners that are watching or listening to this. What are some things that either they bring to you or you just know in the market, like that is another lie that we've been told about money?
So we like to talk about this thing called the latte effect. If you remember hearing like years ago, like, hey, stop buying a latte every day. It costs $5 or $6 from Starbucks. And if you just invested that, for 5 days a week, that's $25 a week, and multiply that by 12 or 52 weeks. I'm not saying that you wouldn't save a little bit of money by, $500 a year, but don't focus just on those types of things. Focus on what are the big things. Do you have an accountant? Do you have a financial advisor, a certified financial planner that helps you understand taking advantage of every tax break, structuring your company in a way, putting money in a retirement plan in a certain way that can give the business owner an advantage? Focus your time and energy on those things that can make big impacts. Where a latte is nice and drinking your coffee, I bought a coffee maker for my office because people kept coming in with paying $5. So I kind of nipped that in the bud, but it was more just a perk, if that makes sense.
Yeah. So what you're saying is, like, business owners, physical therapists, other practice owners out there, for us to make, like, I kind of look at it as like growing. Obviously you want to have profit, but like just growing and expanding your practice. Like, it's easy to kind of look at revenue and be like, grow top line revenue. Hopefully with what you're doing, your bottom line, your profit margin is also growing as well. I agree with you. Like, I also don't go to Starbucks all that often. If I do, it's a brewed coffee. So it's not those $5 or $6 macchiatos or any of those like frappes or lattes that are like sugar bombs and $5 or $6 at a pop. But I agree. So like, focus on the big things. So whether it's hiring, expanding your practice, and then also in the pre-interview, you mentioned like, you mentioned one or two kind of anonymous stories of your clients that are like putting away anywhere from 50 grand a year to 200 grand a year pre-tax with some strategies that you've helped them with. And they're focusing on that exactly. Like, they're focusing on the bigger moves instead of the smaller moves of like taking a latte away from your daily or weekly spending.
Yeah. One example would be So there's these types of retirement plans that exist. Most people are really familiar with, like if you business owners that are out there and you want to provide a benefit to your employees, one big one is something called a 401k, or there's a version that's a little more simple called a simple IRA. These are great benefits to provide people because then they can maybe put some money away for retirement. And then usually you have to put some money in there on their behalf. And so it's a nice benefit. So it's good for the employees. Sometimes it's good for the business owner a little bit, but you have a lot of caps, like a lot of restrictions. You have to do that, and then the business owner can put money away. But let's say you're doing pretty good. Let's say you and your spouse both work, and you were like, man, we're making. It'd be nice if we could use a retirement plan and put an extra 50 or 75 or $100,000 a year. You just can't do it in these plans. And the reason is because they're so restrictive. Well, there's another plan that you can kind of couple with this that most people, I wasn't even, to tell you the truth, for 10 years of my career, I wasn't even that familiar with it. I had a client who specializes in these, who's an actuary, and he educated me on them. And now I've been doing them for a lot of my business owner clients. And if you can put aside an extra $100,000 a year pre-tax, and you were paying a lot of money in taxes, you didn't just put in 100 on your behalf. You really saved, $30,000 or $40,000 in taxes. It depends on what state you're in. That's your money that was going to go to the governments. So you couple that and you do that for a number of years. We're talking it makes an extra hundreds of thousands, sometimes $1 million or $2. I have a business owner client who's a foot doctor. He is going to retire 2 years sooner just because I did this plan, just because of the money on taxes. It's just an amazing benefit. Now, it doesn't fit for everybody, but it is something that you can do, and you can discriminate a little bit sometimes towards yourself, where in those other plans you can't. So that's like one. And then another thing, which is just, it's separate from retirement accounts, but here as a business owner, maybe you're familiar with this, Dave, maybe you're not, a lot of people aren't, is something called the Augusta rule. I don't know if you're familiar with Augusta. It's a golf course. Where the Masters is played, one of the 4 majors. Have you ever heard of this rule before?
I know of the area and the golf course, but not the rule, no.
So this is a pretty incredible rule. You as a business owner, I'm sure most business owners still have like team meetings. Maybe sometimes you take a day off or a half a day off, and then you go and you strategize and you figure out, what are we going to do for our business? You could actually might have to pay somewhere to go to kind of have an out of office meeting. You pay yourself, the company pays yourself. You could do that and rent out your house to yourself up for 14 days. And the money you pay as a company into your business, you pay to yourself personally. It's tax free. It's like a way of getting money out of your company tax-free. You don't pay taxes on it as a person, as long as you do it 14 days or less. And so what we do sometimes is I do these kind of I have quarterly meetings at my business. And sometimes we go to offsites. We pay money to do that. Well, now I pay myself. It's totally legal. The reason is because they set it up years and years, many years ago. All these business owners were going to Augusta where they were doing the Masters, and they were trying to figure out a way, and they had influence with the senators, and they got this rule passed. And so it was a way for them to be able to not pay as much money on taxes. So it's just an example. There's not a ton of them out there like that, but there's a variety of ways that if business owners can just understand and be educated, and again, work with their accountant and or their financial planner, there are some ways that you can make significant impacts to save money on taxes. And then if you save an extra 20, 30, 40, 50 a year on taxes, you might retire a year earlier.
I totally forgot that was the name of the rule. Yeah, I have heard of that. So do you know, and maybe this is some nuance that someone will have to not, if you don't know it or if you don't want to answer, but like, do you have to own the house? You can't rent it. Like I'm in Brooklyn, we rent right now. So like,
yeah.
Do you have to own the property or have a mortgage on the property?
Yeah. It has to be in your possession. As far as I know, I have 2 houses. I have a lake house. And so, I can do it at both. So I can actually do it at both if up to 14 days. Now, lake house isn't very close. So I'm not going to get my employees to come. I don't know if it's quite worth that, but it is an option, and sometimes it works fairly well. And so I would say good accountants definitely know about this. So you as business owners, you want to talk to your accountant about it, and or, your financial planner. And not all of them are familiar with it, financial planners, but some are. that
And
specialize.
of course, you'll have the audience will have to ask their own accountant about it. But is there like depending on the state or city or whatever, like is there like a certain rate of the 14-day? Like, is there a cap or something like that?
Yeah, I mean, it's the going rate. So I have one business owner recently who is in Naples, Florida, and lives in a really like in a condo, but it's a very expensive condo. So his rate he can use is much, much higher. And for example, my home is in a nice suburb of Chicago, but it's not like a super expensive one. But still, I could rent it out. Maybe not nearly as much as him, but it has to go. It can be the going rate in the area.
Got it. Got it. Okay. How about maybe one more? Any like a popular one or anything that we've overlooked in terms of any lies that we've been told about money? How, I mean, like, and if you can't, maybe you got something?
Oh, go ahead. Go ahead.
I was going to say, so like the whole financial advisor world, right? So like you talked about in the top of the show, like about trust and all that, and it takes a while for you to build relationships and all that. So like, I think some of the most successful business owners, practice owners out there have like a lot of most of the things dialed in, right? So they have an accounting firm if they're, doing $1 million in revenue or more, maybe. They don't have just like a small independent like solo accountant, and they have a law firm. They have a lawyer that they probably lean on, but usually it's like a law firm, not someone independent. They probably have a financial advisor. They have a lot of the major pillars. They have folks in their corner that are like specialize in all the things that they need, as opposed to trying to be a specialist in the physical therapy delivering physical therapy, then trying to be a specialist in all the areas of like finance and law and taxes and all the things that we're talking about. So I don't know, maybe that is like, I don't know, are there more and more people going to financial advisory? Is it still a myth? Like you could have a couple $1 million business or grow your own multi-million dollar portfolio for retirement without financial advisory? Maybe that's something.
Yeah, no, these are great. That's a great question. I would say it's interesting and surprising. I mean, you might be a little surprised. There's a lot of business owners that don't have someone who's a financial advisor, or even more smaller, tight-knit type of person, which is what we are, which is called a certified financial planner. And what I mean by that is, think about it, a lot of these business owners, like you started your own business, I started my own business. And we all know, like, we had to put in a lot of blood, sweat, and tears in our own money. And a lot of times, like that extra money you have, you could have invested in somewhere in type of just some mutual funds or ETFs or with an advisor, but instead you invested in yourself. So some of you business owners out there probably have some money in investments and maybe old retirement accounts and when you worked at another company, but you invested in yourself. So they don't all, a lot of them don't. But what I would say is the biggest misunderstanding when people come and some of the myths, they think we're like financial advisor kind of / investment people. And I do know a lot about investments, but that's not where I make the biggest difference in people's lives. It's like those examples I just told you. Is being a certified financial planner, there's about 10% of the advisors out there that are that. And what we do is we help people thrive financially. A good certified financial planner, and I have a podcast that just says, what is financial planning? And it's making sure that in every decision and area of your financial life, we help you make the right kind of decisions that you protect. Like, I mean, one area is I'm not an insurance expert, but I analyze every single insurance policy that somebody has. You probably know what this is like, Dave. I mean, you want to make sure you're covered. You're covered in every area. Imagine if you built up your business. It became worth a tremendous amount of money. If you don't have one kind of insurance policy, you better go get it right now, Dave. Everybody should own one of these. It's called an umbrella policy. Half the people I talk to go, I don't know if I want to know. What is it? And then I tell them, you have to have car insurance. It's mandatory. You have to have home insurance. It's mandatory. But those only cover you up to maybe a quarter or $500,000 a year. You drive your car down the street and you accidentally hit somebody and you paralyze them and they sue you for $2 million and win. It comes out of your pocket. You do something at your house and a tree falls on somebody's car when they're driving it or whatever. My point is you need to make sure you have the right kind of insurance that protects your business, that protects your investments. And so what we do is we analyze every area: insurance, we analyze estate planning, making sure your whole thing is set up correctly. We're not attorneys, but we make sure it's set up correctly. We analyze tax planning, making sure that you plan everything appropriately. Make sure your retirement planning is in place. When you sell your business, you're going to get a lump sum, hopefully, or get it paid out over a couple few years. What are you going to do with it? How do I know when I kind of know what it's like? I'm in the middle of with another doctor right now selling his practice. He actually is not going to retire for 5 years. He came to me and he said, I think this is a lot of money. I think I should take it. I did the numbers and realized, you know what? You need to get more money. Otherwise, he's doing that retirement plan I told you. He's saving so much money on taxes in this other retirement plan that he's doing. He'd be better off not selling his practice. Now, that gives him leverage, right? Because he can get more money when he sells his practice. So my point is that when you have a good certified financial planner, they help you in all these different areas of your life. I don't think people fully realize that a good financial planner will help them kind of walk through all of those things.
Got it. Now, how do you charge? Is it like a quarterly or monthly fee, or is it a percentage off of an improvement of someone's portfolio? Like, how do you, and obviously for the specific rate, they can reach out to you guys, but in how you guys, price your offering, like how does that even work?
Yeah. So the way we work primarily is if people do have some investments, we charge like a percentage off of that. But if they're business owners sometimes and they need some consulting help, we can charge certain fees to help them kind of do some of these things as well. So that's like a monthly, quarterly fee until they like monetize and get their money.
Like a consulting fee kind of thing?
Right. Yeah. So like we help them kind of look at their whole plan, and then they pay us a fee to kind of do this comprehensive plan to help them look through and walk through everything. And sometimes that's enough for a little while, and then we revisit it later on. But they work with us for, usually up to like a year to kind of get all their ducks in order. And then if we can help them in the future, then we just, look at that, maybe going forward in future years until they eventually sell their business.
Got it. Obviously, you're not a tax attorney or anything like that, but what about are there any big lies that we've all been told about taxes, specifically about like business owners and our taxes?
I don't know about lies, but certainly, a lot of times, I don't know. I mean, I've been married for a long time. My wife's helped out with me indirectly. If people have business owners or business owners have family members that help in certain ways, there's incredible ways that you can employ your loved ones or the people that you're close with. They can help you do certain things. And it's a great way to get money into like retirement plans, things of that nature. Even your children, like my children, I have 3, 2 of them helped me on the weekends clean the office. And so it was a great way for them to learn as they were learn about money, but also we could get money into some retirement plans for them. And when you're really young and you can get money in retirement plans, it's just incredible tax savings. So it was a great way for me. I got to pay it to my kids, and that was a business expense. And then they got to put it in a tax efficient way. And so there's a variety of ways of looking at where are you spending all your money? Are there deductions? Are there things out there, ways that you can kind of structure things so it can save a lot of money in tax? Like I said, if you have a good accountant, they will inform you of most of those things, but sometimes they miss things too.
Got it. Is this, or the 529, so we have an infant, 3.5 months old. And we just started the 529, like what is it, like a pre-tax college fund for your kids? Is that something that you guys deal with or no?
Yeah, we do. So they're not pre-tax. You're putting after-tax money into it, but what makes it super appealing is that as it's growing, you don't pay any taxes. And if you use it for your child's schooling, when you pull it out, you don't pay taxes. So you don't get the triple benefit of tax savings, but you get the double, meaning you pay after-tax money goes in, then it grows tax-free, and then it comes out tax-free. Now, the one thing you could get, it depends on what state you live in. I live in the state of Illinois, which is almost a 5% tax. It's 4.75% state tax. Contributions up to $20,000 in the state of Illinois, I get to deduct off my taxes. I save $950 a year, or I did. My last child just finished school. But I saved $950 a year every time I was contributing. And so it depends on what state you're in. You might get a state tax deduction. There's really only one, and I'm gonna just because I want to make sure people know about this. There's one thing out there that gives you the triple tax savings. Goes in pre-tax, grows tax-free, and comes out tax-free. It's called an HSA account, health savings account. People are sometimes familiar with it, but if you have a certain kind of health insurance, you can contribute. It's not a huge amount, but you can contribute, close to $8,000 a year, and that money can be used for medical reasons, prescriptions, doctor's office visits.
We kept it all the time for our clients, our patients out of pocket, because we're mostly out of pocket and out of network. So we don't really take a lot of the in-network. We don't take any in-network insurances.
Yeah. Everybody should do it themselves. Like, I know you're doing it when it's come in, but everybody should do it. And what can happens is if you put money into that thing every single year and you don't need it, you can invest it like a retirement account. And eventually, if you don't need it all for medical, then you can pull it out and pay taxes on it when you're retired. But here, let me tell you this, eventually you're pretty young. It looks like you're in good shape. You probably don't have many, medical expenses, but there will come a day that you may. And even if you got 100 grand in that thing or 200 grand in that thing, if you can pay for that with pre-tax dollars, it saves so much money on taxes. It's just, there's no downside to it.
So there's the health savings account, and then there's we also have a lot of patients and clients that have the FSA, the flex spending accounts. So the FSA is the one that expires every year, and then the HSA doesn't.
That's correct. The HSA doesn't. It just keeps going on and on and on. I had the FSA when I used to work for a big company, and I remember like having it at the end of the year say, "Oh, I'm going to get LASIK surgery next year. I'm going to set aside, but I don't want to do too much because if I don't, then I lose it, right?" But the HSA, you don't lose it. It could be used for your benefit for the rest of your life, and if you don't use it, it's just like a good old IRA account that you eventually have to pay taxes on, or somebody does, but there's no downside to it.
But can you pass it along? Let's say, can you pass it along to a dependent? Like if someone's of a certain age or whatever, like or after, God forbid, after death, like can an individual, if it had hundreds of thousands of dollars in it, can they pass it along, or it has to be cashed out and then the state wants to take their tax cut on it?
Yeah, you could pass it to a spouse. No problem. They can keep it going. If you leave it to a beneficiary, let's say a child or something like that, then there's tax laws that state any IRAs or these health savings accounts, the government just makes you start taking some out over the course of 10 years, and then you got to pull it out then. But it's just regular taxes. There's no penalties or anything. So it's just like if it was an IRA account being passed on to an heir. So it still works out really well.
Interesting. I appreciate that. So Ed, thank you, because I think I was under the understanding that they both expired every year, and if you don't use it, you lose it. But that's just the FSA, not the HSA.
That's right. That's right. Now, you do have to have a higher deductible. Most people have higher deductibles because insurance is just so crazy.
Yep.
I can't remember the number off the top of my head, but it's at least $2,500 or $3,000 deductible. I mean, ours is like $5,000 or $6,000 for per person and my family, and so almost everybody qualifies. But they just don't want you to have those low HMO or really low paying PPOs. Then you don't qualify for the HSA.
Right. Yeah. I mean, it's almost like, so then it's like the HSA almost either popped up because of, or has grown in popularity because of these higher deductibles.
That's 100% right. That's right. And then if you're healthy, like I have an employee at my company who's in his late 40s, and he is basically he's been putting money in it for many, many years. He has a large sum of money in it, and he was investing it. Well, he got married like a couple of years ago. Now he has 2 kids, and now he's got all this money in this account that he can use to pay for his children, basically, with not paying any taxes on any of it. So it worked out great for him.
So just to recap, the HSA, it's money that goes in pre-tax. It grows tax-free or fee-free, and then you can take it out tax-free. Is that what you said?
Yeah, so it goes in pre-tax. It grows tax-deferred. If you use it for medical reasons, it comes out tax-free. So the whole thing was tax-free, the whole thing. If you don't use it for medical and you eventually use it just for retirement, then it's like it was an IRA or a 401k. You got to pay taxes on it when it comes out. Wow. We just never know. We don't know. If you're healthy your whole life, then that's okay. It was still a good retirement account. And if someday you have a lot of medical expenses, then it's really good.
An IRA or a Roth IRA or whatever, wouldn't that money compound with a higher rate or a better rate compared to an HSA? Are they like similar type of vehicles or
Yep.
structures?
Nope, that's a good question. They're just holding accounts. In an HSA, you can invest it any way you want. You could put it into an investment account at a like mine's at Fidelity Investments. It's a big, huge custodian that holds, and I can invest in almost anything I want. So it can grow just as fast in anything I want as long as the HSA is being held at an investment company. Now, some of them are held at banks, so they just get like interest. It just sits there like a savings account. If it starts accumulating, you're not using it every year, I encourage you, move it to an investment company like Fidelity or some other company. And then you can leave a little bit, like a couple, like I have a client who leaves like $5,000 just sitting in the money market so she can use it as, because it gives you a debit card. And then we invest that, she has a big chunk of it and we invest the rest, just like our regular investments. So super flexible when it comes to what you want to do with it.
Very, very interesting. All right. So we talked about lies we've been told about money, taxes. Now I want to talk to you about exits. You just gave an example a little bit earlier how I'm on the buy side, so I'm going to joke and say that you cratered that deal because you said you told your client don't sell now because you can.
No, I didn't say that. I said for this particular client, he wanted to. He's going to get out in 5 years. He just knows he's getting out. He wasn't going to sell right away. He was going to sell and stay on for a little bit longer.
Okay.
And so he wasn't going to get out right away, no matter what. But what I did was just said that, we just got to look at it from all the angles, right? I mean, once I'm ready to sell my business, it's not going to be for a while because I love what I'm doing because I'm buying businesses like you. But you need to make sure you look at it from every angle. You just don't look at it, oh, here's the sum of money I'm going to get.
Got it. So the different structure.
Question though around that. You were going to ask a question around that.
I was going to ask another one.
I don't know. You were going to ask a question like, hey, this kind of created my deal, you had a follow up or something. I kind of think I messed up.
I was just saying because sometimes we're submitting offers, we're talking with practice owners, and then, their lawyer is trying to act tough and maybe the deal falls through because of that but listen, whether it's you're in their corner or a lawyer, accountant or whoever, or broker or advisor, whatever, whoever's in their corner, like they're trying to guide them the best way possible. They want to sell they would want to sell for the highest dollar amount. We are trying to get a fair deal or, maybe
right.
A bargain out, whatever. Like we want to spend the least amount and the other side wants to make the most amount. I was just, I was just ribbing you a little bit by saying like that example sounded like you said to him, hey, don't take that offer, don't sell because this other route is going to be better for you in the next couple of years compared to if you sold right now.
Yeah, I get it. Right. I understand.
All right. So you've bought businesses with your clients over the years, like whether they're in healthcare or not. What are some of the considerations around a business owner or practice owner selling 70 or 80% of their business, or they're selling 100% of it? What are some of the money or tax, or again, I know you're not a tax advisor or a tax advisor, tax accountant or a tax attorney, but what are some of the financial implications, right? They need to speak with you. They need to tell you, here's something I'm considering. And then in some cases, it might be like, hey, if this deal goes through, like they're going to wire me, $1 million or $2 or $3 million or whatever, depending on the size of the practice. That money needs to go somewhere. And I'm assuming you would have to have a plan up front ahead of time before this actually even remotely happens.
Right. My hope is that we would actually be maybe working with these people before this happened or as they were leading up to it. And the reason is because sometimes people kind of come to us like right when they retire or like right when this is happening. And that's great, except then they're like, okay, well, what can I do? Well, if they can actually do a little preparation, kind of planning ahead of time and be like, hey, I'm thinking about maybe going to talk to a guy like Dave and his company, and I eventually want to sell and it maybe sometime soon, then what we'd want to do is go, well, how much do you think you might be able to get? Like, and how much do you have in other investments? And what we want to do is more of like retirement planning of like, once you determine about how much you're going to get here and about what you're going to do here, here's what your future is going to look like. Here's how you can kind of ride off into the sunset. Then we also strategically want to look at, well, Dave, I'm guessing, when you do this kind of thing and you're purchasing other companies, you sometimes come to them with a couple of ways, like, hey, I can just give you a lump sum. I can pay you over a couple of years if you want to stay a little bit, And so what we do is we say, okay, you want to look at these as a seller, you want to look at these options and say, what's going to be best for me? And also, I want to get it so I'm going to pay the lowest amount in taxes. You want to get paid, so it's paid in the form of usually what's called capital gains, because capital gains taxes are lower. And can we spread it out? Or do we want to get paid like maybe in a year where I'm not making as much money because I might be in a lower bracket? So these are just good, solid, strategic ways of trying to minimize taxes. If you sell your business and you can save 10% overall in taxes, you sell it for $1 million, that's a lot of money. If it's mostly taxable, you could save $50, $100, $150,000 a year. And Dave, I'm guessing it doesn't matter to you because you're not paying the taxes on it. You just need to make sure you're giving them a fair deal and that you're getting a fair deal, and you have no problem them getting it a certain way. And so those are the two things that I would want to make sure that people are fully working through for their situation.
Yeah, awesome. So how about this as an example? So let's say if you hypothetically had a physical therapy practice owner as a client, let's say we were going to buy their practice, and let's say we were in the ballpark of $1 million purchase price, and every practice owner, every business owner, every seller out there, like everyone wants to sell for top dollar. They want the max value. They want the most money. They want the big check, which is fine, like totally fine. Let's say we're going to say, all right, we agree. We'll pay $1 million for your practice. What are the considerations or the discussion on your side in this type of a hypothetical example? Like they're going to get hit by like a big tax amount, could be 30%, right? Depends on a lot of things. It depends on maybe the state or the structure or whatever, versus like some practice owners, and in this fake example, I want to kind of inject a little like the seller's finance as an option, the delayed gratification. So like instead of we could say, hey, we could buy your practice for $1 million. Go tell your financial advisor Ed and your accountant and your law firm or whatever. We'll buy it for $1 million, or we could buy it for, 1.2 or 1.5 or maybe even $2 million or whatever, if we have some amount of it deferred, like maybe 25% or 50% or whatever. We're gonna pay you deferred. There's going to be an interest rate on that. Maybe we could defer it for a year. Maybe we defer it 6 months or 3 months, whatever. And then you start getting these monthly or quarterly payments from us. We'll give you some cash down at the closing date. They'd have to agree upon it, but they would get taxed less, right? They would have more money in their pocket, taxed less, but they have to wait more to get all that money, right? So, have you as this hypothetical example, what would you say to your client? Like everyone wants the big check at the end of the rainbow, but they're going to get hit a lot of tax, which they might not even realize up front. That's where you and the accountant and the law firm all come.
Yeah.
What are your thoughts around like the two examples, like $1 million, but a lot of taxes taken out of it, or maybe a little bit more than $1 million, but it's deferred over the next, I don't know, could be 5 or 10 years.
Mm-hmm. Mm-hmm. Yeah. No matter how long it's deferred, what we do is we have to look at something called the time value of the money. So if you're willing to pay them more, we got to make sure that you're willing to pay them more, which is enough to at least keep up. The first thing that pops in my head is if they take the lump sum right then, that's probably, if they're doing it in a year where they're making good money, and you're not going to buy a practice unless it's attractive, right? So that means that business owners probably making good money. They're getting this lump sum check. Now they're paying top dollar in taxes. So how much are they going to get in the end? Like after the taxes, that's what I care about. Are they going to get a big discounted rate because all the taxes are coming out right away? I might be able to show them, hey, wait a minute. If you spread this out over 3-4 years, after this next year, you're going to be in a lower bracket. Dave's going to pay you a little bit more, and you're going to pay, maybe you might pay not the 20% capital gains. You might be able to pay only 15%. We can set everything up over here So we're going to save you 5% on taxes. You're going to get a little bit more from Dave. Then we got to compare that. And they might say, hey, what if I invested with you, Ed? Would I be able to make it up? And we'd have to look. And I could say, well, if the stock market's doing great, but nobody knows the future.
Which you can't guarantee, though. And that would all
no. And I tell them that. I specifically say, hey, bird in hand is good. I don't guarantee anything. There's nothing out there. I'd rather have them create some stability where we know we're going to get more than that, because eventually they're going to be investing it for a long time, knock on wood, hopefully. And so for that reason, agree 100%. It's better to kind of structure it, spread it out if you get enough. And it's good for someone like you probably, because spreading it out is a good thing too, because then you don't need all of a sudden quite as much up front. So it tends to work out for everybody.
Yeah, maybe we're going to need you guys on the front end to counsel some of these potential clients, because it's like a lot of the business owners, the practice owners we've spoken with, like they want the big dollar amount at the closing date, and the taxes are not even, like, it's almost as if they haven't even gone down that road of like that exercise of comparing, like, well, bird in the hand versus two in the bush, like the money now and the taxable event versus in the future. Like everyone, I feel like a lot of the owners are just thinking about the end of the runway of like just the transaction, the acquisition or the partnership or whatever event that we agree to. And they're not really thinking about like after closing and how much money they need to continue to live and their quality of life and traveling and all that. So it makes sense to, like I said, that's why it made sense to have you on here, because we can kind of talk about some of these things and you've been on kind of both sides of the table.
Yep. Yep. No, I mean, as I told you with the example with that other business owner, they called me and told me they were getting close. And then I asked them these questions, and the husband, he's the one who was the primary worker, but she was an office manager there. He was like, yeah, I want to do it. And I was like, let me look at the numbers. And when I did, then I was like, you need to ask sometimes for a little bit more, or you could take it this way, but here's what you're going to get and here's what you're not. I think it's just good to kind of go in and understand all the different options. And sometimes it might be what your gut reaction is, but sometimes, physical therapy business owners, people who own businesses, they're not experts in every area. They do need to rely on other experts to be able to help them kind of play out the different options.
Yeah, they can't be. We all can't be experts in every area. That's what I was kind of saying. We need to have a law firm, accounting firm, maybe financial advisory, all that type of stuff, different areas of specialization. Ed, this was awesome. We talked about money, taxes, practices, exits, all that. Anything else as either a recap or to wrap up, any like major topic or just final remarks that we maybe glossed over or we skipped over?
No, I'm just going to reiterate the thing I said before about it is worth your weight in gold. I mean, I'm biased, but it's worth your weight in gold to at least talk to a financial planner, someone who's called a certified financial planner. It's this, it's like getting a master's in the industry, and a certified financial planner will holistically look at every piece of the puzzle for you. It's so important. And also it's good to work with somebody that's called a fiduciary. A fiduciary is a term in our industry that not all advisors are fiduciaries. Fiduciary means that someone in my position has to always put my client's interests ahead of mine, always put my client's interests first, every single decision that we do. And you can only work with advisors that in a pay structure like ours. You cannot work with advisors at certain places because they can get paid differently. It's not that those advisors aren't good. There's a lot of them that are really good that are out there. But if you know that you're working with someone who's going to holistically look at your situation and that they're always putting your interests ahead of theirs, that's a really good recipe.
Awesome. That's a great place to pause. What's a good place on the internet, Ed? Your website, your company's website, or LinkedIn, or any other place for the audience to reach out to you?
Yeah, my LinkedIn is Ed Meek. My practice is in Wheaton, Illinois. The name of it is called Edge Financial Advisors. And our website is edgefa.com, edgefa.com. And then I got a tab on there for podcasts. I've done like 45 podcasts on a lot of different topics, kind of like what you do. And they cover lots of different things. And so feel free just to go on. I'm on all the platforms, Spotify and Apple and all the platforms too. So you can listen to them and watch them if they be of interest to you. And lastly, I love to cook. I love food. One time I thought I called myself a foodie, and a buddy of mine said, "You're not a foodie, you're a chow hound." And the reason is I just love good food, mostly at not even expensive places. And I just have a few good recipes. And so on my podcast, in the end, I either share a recipe or an awesome meal. So feel free to grab one of those if you're interested too.
There you go. And you mentioned Illinois right there a minute ago, but you can potentially have anyone that watches this, like from any state, could potentially engage with you guys. They don't have to be in Illinois, or they do.
Yeah, no, they don't. In fact, not even half my clients are in the Chicagoland area. They're all over the country. I work with them all over the country. And so I do travel from time to time in different areas of the country as well. So we help people everywhere.
Awesome. Ed Meek, thank you so much for your time.
Yeah, thank you, Dave. Really appreciate it. Take care.
Hey, it's Dave Kittle. Are you a healthcare business owner or physical therapy practice owner who is looking to figure out your succession plan or exit strategy? We might be able to help. And in fact, we may be interested in acquiring your practice. If you're interested, you can reach out to me. Shoot me an email at dave@conciergepainrelief.com. That's DAVE at CONCIERGE painrelief.com. Or you can call me at any time, 646-781-8884.